In today's video, we're going to review 10 seriously undervalued stocks to buy right now. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. It's not uncommon to find growth stocks trading at a valuation premium. The markets give this premium based on how the company is expected to grow and how its technology is different. But even dividend stocks and blue-chip stocks have a higher price than the market as a whole. The main reasons are strong dividends, creating value through repurchases, and clear visibility of cash flow. Finding undervalued dividend stocks is not an easy task for investors. Even so, this year has been hard for stocks, and when the market is bearish, it often causes extreme moves in the wrong direction. The result is that there are several undervalued dividend stocks to buy. We believe that these undervalued dividend stocks can deliver healthy capital gains in the next 24 months. Also, dividends can be paid out for a long time, and dividend gains will boost total returns, which is important because consumer spending is a big reason why the economy grows. Let's review our list of the 10 undervalued stocks to buy right now. Number 10. Target, ticker, TGT. Target is a dividend aristocrat, having increased its dividend payout to shareholders every year for almost 50 years. After a banner year in 2020 during the start of the COVID-19 pandemic, the company increased its revenue again in 2021. Shifting consumer spending and inflation put a dent in its profit margins in 2022 as households refocus on essentials rather than bigger ticket items. The longer-term potential is still there for Target. Best known as a big box store, Target has transformed itself into a one-stop shop that sells everything from groceries to basic household goods. Target also has its own in-house labels in traditional department store categories such as apparel and home decor. Additionally, almost all U.S. residents live within 10 miles of a Target store, helping the retailer to turn its locations into distribution centers. Some 95% of all orders are placed online and shipped to customers' homes are now fulfilled by local stores rather than distribution centers. Target also offers curbside pickup and is expanding its ship delivery service. In the coming years, Target expects to increase its annual capital expenditures to about $4 billion. The spending will be used to open new stores, remodel existing stores, and improve supply chains, a sharp increase from the approximately $2.7 billion it allocated annually from 2016 to 2020. The company is also committed to expanding its e-commerce operations while continuing to pay a reliable dividend. The company's stock, however, still trades like it is only a brick-and-mortar retailer. Target is implementing a multi-pronged strategy that effectively leverages its physical footprint. E-commerce pure plays are all the rage, which also contributes to Target stock being undervalued. Number 9. Cisco Systems, ticker, CSCO. Cisco Systems is a tech company in the US that makes and sells hardware for networking. Cisco also sells software for businesses, such as domain security, video conferencing technology, and connectivity for the Internet of Things. Shares of networking hardware giant Cisco Systems have trended lower this year, just like most other tech stocks. A 25% decline in the stock price has made it look cheap. Cisco reported adjusted earnings per share of $3.36 in fiscal 2022, which ended July 30th, putting the price-to-earnings ratio at 14. Although the S&P 500 is only down by 16%, CSCO shares do pay a yield of 3.13%. This means that Cisco shares are performing slightly worse than the market this year, but still better than most growth stocks. Cisco's dominant market position and inexpensive valuation make it one of the most appealing tech stocks to buy right now. However, anyone who's considering investing in Cisco needs to understand that the company's revenue and profits can be a bit volatile. An overloaded backlog is smoothing things out right now, but that can't last forever. Be ready for a revenue and profit decline sometime next year if global economies continue to deteriorate. In the long run, Cisco is aiming to grow revenue and profit by 5% to 7% annually. But that won't happen every year. If you're a long-term investor able to stomach some temporary setbacks, Cisco is a great stock to buy. Number 8. Verizon Communications, ticker, VZ. Verizon Communications, commonly referred to as Verizon, is a US-based telecommunications company. Verizon is currently the largest wireless provider in the United States, with over 142 million subscribers as of Q2 2022. Passive income investors certainly know about Verizon's healthy dividend yield, but there is more to know about the company. Like many stocks, Verizon has been hard hit by the increases in the benchmark interest rate. Some treasury bonds now pay out more than VZ stock, which has changed how investors feel. Verizon shares down over 25% as of November 2022. The company delivered its 15th consecutive annual dividend increase in 2022. Verizon should be able to continue increasing its dividend as it invests to transition its mobile network to 5G, thereby bringing faster data speeds to its customers. For those interested in a turnaround play with a strong dividend, Verizon is worth a look. Number 7. AT&T, ticker T. For the year to date in 2022, AT&T stock has been sideways. At a forward price earnings ratio of 7.3, the stock looks seriously undervalued and poised for a big rally. On a sustained basis, AT&T has reported growth in postpaid phone and fiber subscribers. If the average revenue per user goes up and costs go down, it seems likely that the margin will grow. We're bullish on growth with 5G wireless subscriber additions. AT&T has already created a robust 5G infrastructure in the US. It's also worth noting that AT&T has reduced its net debt by $25 billion for the year. Deleveraging is likely to continue and will positively impact valuations as credit metrics improve. Additionally, AT&T has forecast a free cash flow of $14 billion for 2022. In order to keep dividends at their current levels through 2023, healthy visibility is required. Number 6. Pfizer, ticker PFE. After remaining sideways for the last 12 months, Pfizer stock is another of the undervalued dividend stocks to buy. The dividend yield on the stock is 3.25%, and the forward price earnings ratio is 7.6 at the moment. Cash flows from sales of COVID vaccines will go down, which is one of the main reasons why valuations are low. Last year, Pfizer reported $29.9 billion in free cash flow. But the markets don't seem to care that Pfizer's long-term growth story is still strong. The company has a deep pipeline of drug candidates. A robust late-stage pipeline is an indicator of growth in the coming years as new drugs hit the markets. Pfizer has also utilized the cash flow surge to pursue acquisitions. This has aided in the expansion of the product pipeline. To put things into perspective, Pfizer expects $25 billion in incremental revenue by 2030 from new business development deals. Also, the company has said that new drug launches over the next 18 months will bring in $20 billion by 2030. Number 5. Ford, ticker F. Ford stock seems to have bottomed out because the stock has remained sideways in the last 6 months. Importantly, a forward price earnings ratio of 7 indicates that F stock is seriously undervalued. As Ford starts a big plan to change the way it does business, we're optimistic about the next few years. By the end of 2023, Ford is targeting an annual EV production rate of 8.4%, which is another quality dividend stock trading at attractive valuations. The stock trades at a forward price earnings ratio of 9.4. Even after considering market headwinds, the stock seems undervalued. Number 4. JP Morgan Chase, ticker JPM. In October 2022, JP Morgan Chase stock traded at a low of $101.30. JP Morgan stock is already more than 30% higher than it is now. However, the 2.98% dividend yield stock still trades at a forward price earnings ratio of 11.6. We believe there is more upside potential for this banking stock. The policymakers have aggressively increased interest rates through 2022. This has translated into higher borrowing costs for consumers and businesses. JP Morgan has indicated, however, that consumers and businesses remain healthy. This would possibly imply decent credit growth even amidst the rate hikes. The bank has already revised its net interest income guidance to the upside for 2022. The positive momentum is likely to sustain itself in the coming year. The outlook for credit growth will be improved even more if inflation declines in comparison to other factors. As a result, we have a bullish medium-term forecast for JPM stock. Number 3. Chevron Corporation, ticker CVX. Chevron has released its 2023 capital spending plans. The oil company sees its capital budget surging 25% over the coming year. That's a notable increase, considering that the oil industry has been keeping a tight lid on investment spending. Chevron Corporation is one of the best dividend stocks to buy now. The company has been raising its dividends consistently for the past 35 years. The energy company pays a quarterly dividend of $1.42 per share with a dividend yield of 3.28% as of October 2022. Piper Sandler liked Chevron Corporation's strategic goals and was optimistic about oil companies in general. Given this, the firm raised its price target on the stock to $190 in September 2022 with an overweight rating on the shares. Management plans to invest a total of $17 billion on capital projects in 2023, 25% more than in 2022. The company will spend $14 billion on its consolidated subsidiaries and invest an additional $3 billion in its equity affiliates. That combined spending level is at the top end of its $15 billion to $17 billion guidance range. That combination of financial strength, traditional and low-carbon energy growth, and shareholder returns makes Chevron a great oil stock to own for 2023 and beyond. Number 2. Realty Income, ticker, O. Realty Income is a giant among retail real estate investment trusts or REIT that has paid shareholders without fail for 629 consecutive months and has raised that payout 117 times since going public in 1994. Over that time, its portfolio has grown to more than 11,700 properties occupied by commercial clients under long-term, net lease agreements that require the tenant to pay for maintenance, insurance, and the like while the landlord just collects the rent. The Fed's continued rate hikes have been the main cause of the Realty Income share price's instability in 2022. When the benchmark interest rate rises, it makes mortgages more expensive, reducing the affordability of homes. Naturally, this impacts Realty Income's business model. After a 26% decline during August and September 2022, Realty Income shares appear to be back on track. Finally, Realty Income's PE ratio of 59.56 may seem high, but it's still well below what it was throughout 2021 and early 2022. Meanwhile, the company has a strong balance sheet, one of the highest credit ratings in the REIT industry, and a long track record of increasing dividends at an average of 4.4% per year since 1994, with funds from operations growing at an average of 5.1% per year since 1996, indicating further outperformance in the future. You can confidently buy shares of this real estate trust and give yourself or some other recipient a gift that will keep on giving through 2023 and beyond. Number 1. Intel Corporation, ticker, INTC. The semiconductor business as a whole, and Intel, in particular, had a bad year in 2022. 2021 semiconductor shortage rapidly turned into a glut. As it pertains to Intel, demand for laptops and tablets went from record highs in 2021 to double-digit, year-over-year declines. In 2021, both Intel and Advanced Micro Devices Incorporated could sell chips as fast as they could produce them. Now, however, inventory is piling up and pricing is heading south. The semiconductor gold rush is over, but Intel still has strong economics. It's much larger than its rivals and has a massive research and development budget. It will be ready for the next upturn in the semiconductor market. The CHIPS Act, which was passed by the Biden administration, gives a big boost to semiconductor companies like Intel that are building factories in the United States. With the recent decline in Intel's share price, shares now yield more than 5%. How to find undervalued stocks. Finding undervalued stocks will mean something different to just about every investor. An undervalued stock means something different to each investor based on how they invest. Some investors, for example, look for stocks that are undervalued based on how much they cost now compared to how much they are worth. In other words, some view undervalued stocks as those with a lot of potential or perhaps with the ability to disrupt entire industries. By that definition, you need to know a lot about each industry and how the stock in question can change to find undervalued stocks. The other way to find undervalued stocks is to use fundamental indicators to determine their true values. Depending on the company's maturity, investors may use the price-to-sales ratio, the price-to-earnings ratio, or several other metrics that gauge the company's value. A good PS ratio, for example, rests somewhere between 1 and 2. Anything less than 2 is considered a good value. Also, if you use the PE ratio, anything less than 16 is usually thought to be a good deal. Undervalued stocks have proven they belong in a diversified portfolio. For that matter, few equities allow investors to tap into more potential than stocks with plenty of room for growth built in. However, to invest in undervalued stocks, traders need to know which indicators to look into and which valuations represent a buying opportunity. Proper due diligence will reveal many undervalued stocks in today's market, but for those of you with less time, the equities listed in this video should be a good place to start. This concludes our list of the 10 seriously undervalued dividend stocks to buy now. As always, it is essential to do your due diligence before committing your hard-earned cash to buy stocks or invest in the market. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thanks for watching, and best of luck with your investments.